How long have you been managing money?
Back since 2016.
Since how long have you been in markets? I think that's a better way to say it. You've been in markets since mid '90s, right?
So yeah, back to the .coms was when I cut my teeth in investment banking in London.
That was my point. So in that time frame around the .com stuff, did you see a lot of anecdotal evidence that we were at a top? And here's what I'm referring to specifically. I just saw the other day that Jim Chanos closed his fund. One of the most famous short sellers of our time shut everything down. And he was, I believe when he shut things down, he was at like 300 million in assets under management, which sounds like a lot, but in the hedge fund world, that is peanuts. Absolute. When you juxtapose that to Kathy Wood, who has, I mean, you'd know better than I would, what, 20, 30 billion or maybe 10 billion, something like this.
Or if you go into things like CalPERS, right, where they're managing pension money, and the pension money is all invested in this
the Magnificent Seven. And I was listening to a podcast today with David Einhorn, someone who I think it's indisputable is extremely intelligent, a very thoughtful, thorough investor. And he talks about his journey of value investing. And he started right around the same time, 95, 96. Did very, very well. I think his best year was 97, where he had a 57% return for his fund. And then everyone's just throwing money at him. And he says he did well up until, I believe it was like 2014. And he said that just no one bought the value, and everyone not only bought what was overpriced, but they continued to buy and buy and buy as a result of passive investing. In fact, he has had a complete shift in his view of the market, and he credits that to a conversation that he had with our good friend Mike Green in 2019. So you see, that's, I guess I'm asking a couple of different questions there. How do you think passive will impact this chart? How do you factor that into your equation? And then do you look at that anecdotal evidence of like Jim Chanos shutting down his short fund? That's the time that you might want to go short.
Okay, so I've got a treat for you guys. Go to answer the question. Let's go to the chart number 3. Okay, to give you, so because you talked about the .coms, right? So in the .com era, we all know now what that was. We had extreme valuations within the .com stocks. At the same time, and this is probably what Einhorn is talking about, if you had gone and you had purchased old economy stocks, your trains, your smokestack stocks that nobody wanted to know about.
Yeah.
So S&P was down some 45, 50%. If you were in the internet stocks themselves, a lot of them just went away, and about 90% of them did actually go away, completely went away. But it was a fairly horrendous bear market. You could have not only escaped that bear market, but you would have produced around about over a sort of 3-4 year time frame, about a 50% return simply by going and buying boring, shitty old smokestack stocks, value companies. And very much akin to what we're looking at today, they were printing money. The free cash flow from those value stocks far exceeded those in the .coms. Today, we're looking at exactly the same thing. There's a couple of sectors that I would point out, which are present a lot of asymmetry within that. But if we just have a looking at this chart, where you've got the Magnificent Seven, and by the way, anytime you have the markets and the mainstream media coming out and giving names like the Magnificent Seven, it's like the Nifty 50.
Right.
They're literally telling you that this is a dangerous environment to be in. Okay. Now, I don't know if it stops tomorrow, George. I don't know if it stops the day after. What I do know is what's expensive and what's cheap. And I do know that if you buy what's cheap and you stay away from what's expensive, that works. This is not complex. And so Here we're looking at the Magnificent Seven, and the market cap of these exceed. You could buy all of Japan, France, China, which is the largest, arguably the largest economy in the world. You could buy all of these for less than the valuations.
You're talking about the entire stock market.
Yeah.
Yeah.
So is this an extreme? Sure, it's an extreme. Of course, it's an extreme. Now, if we think about the revenues, right? Because revenues in a normal world, revenues and profitability should drive value. Okay.
Right.
If I've got a business and it's generating 2x revenue of your business, I should have a valuation that's roughly 2x yours, maybe a little bit more, depending on my growth rates, maybe a little bit less if you've got a really fast growth rate. So growth rates can come into it. But what we have today is just so out of kilter that it's amazing. And back to what Einhorn was talking about with respect to passive capital, one of the things that we've noticed and where I think investors have a huge edge is in timeframes. And the reason that I say that is that much of the capital over the last 15, 20 years has moved from active fund managers into the passive world. Why? Why would you pay some dude 2 and 20 when you can toss it into an index and pay 50 basis points or 75 bips and just let it run? Now,
and the index outperforms, ironically.
The issue that you have is that passive capital has grown so large that it cannot actually deploy into small market segments. Not very easily, because there isn't the liquidity. If you're running multi-billion dollar ETFs or mutual funds or any of these structured investment products, it becomes more difficult for you to have any significant allocation towards it. You might have 0.5% or something, but it becomes very difficult to do it. And so as a consequence, the capital doesn't go there. That, in my book, has opened up significant opportunity. And the more capital that has moved towards the passive industry, the more it's just gone into things like Nvidia. Nvidia's market cap now is over $100 billion higher than the entire S&P 500 energy sector combined.
Wow.
Okay. So think about this. You can buy the entire energy sector for $100 billion less than buying Nvidia. Now, if you have a look at the next slide, this is where I think this stuff
Microsoft
matters.
versus energy.
So here's cash flow. Here's your free cash flow.
Yeah, that's going to be my next question.
Again, back to that scenario. I've got a company that's making 2.5 times the revenue that yours is, or vice versa. Which should you buy? Again, this is not complex, but what we're seeing is a massive anomaly, and I would suggest that that's an asymmetry that you would want to take advantage of to some degree, at least. We can debate what sort of position sizing you want to have, but to simply to acknowledge that one of these looks risky and one of them looks less risky, I think is it's pretty easy to make this call. And then you can ask yourself, well, what's going to make it go higher, right? Because at the end of the day, the only thing that makes a market go higher is more participants. Right? So who else is going to come in and buy the Magnificent Seven? There's two ways that you can do it. You can have more participants, you can have retail, you can have whoever. Someone that's not currently invested can come in. And the other one is leverage. And guess what we've just seen the last week or two? If we go to the next slide.
Okay.
This was published on the 5th.
And this is largest U.S. pension fund bought up Intel and Nvidia.
But if you go into the article, and you'll see that's where I've snapshotted one from the FT. They're doing it with leverage. So these are the only two ways that you can push these equities higher. You have to ask yourself the question, who's going to come in after them to push it ever higher? If you were buying today, the only way you're going to make money is by the stock going up or dividends. And guess what? These things don't pay you any dividends. So I don't know if this is the top, but I do know what's really risky. And when you're adding leverage to this, watch out. This is, in fact, going through that .com era, we never saw anything this crazy. And that was pretty crazy. We had never seen anything this completely bonkers crazy. And if you go to the next slide, it'll show you just how extreme this situation is relative to the previous bubbles that we've had. I would look at this, George, and say this is a significant opportunity. Rarely in one's investor lifetime do you have these sorts of extreme situations. Very rarely.